the earlier you can start, the better. And, start your kids and grandkids if you can. I started my son investing at 10 years old. But even if you're older, if you're, in your 70s or 80s, this strategy is going to be more conservative than most stock investing strategies. It's going to generate income. It's going to grow your income. So even if you're not reinvesting the dividends, if you're collecting the dividends, but if you're invested in dividend growth, then you're hopefully keeping up with and outpacing inflation. So even a year like this year, where we've had some pretty high inflation readings, hopefully next year, because of the dividend growth strategy, your dividends are increasing your buying power, even in a tough inflationary environment.
Today's conversation is a roadmap to take control of your finances and set yourself up for a safe and comfortable retirement, no matter what. My guest is Marc Lichtenfeld, who is the Chief Income Strategist at Wealthy Retirement and the Oxford Club. He's an author, speaker, and financial writer to over 500,000 readers who receive his work each and every week. He's appeared on CNBC, Fox Business, and Yahoo Finance. And his best-selling book, Get Rich with Dividends, A Proven System for Double-Digit Returns, is not only a bestseller, but was awarded the Book of the Year by the Institute for Financial Literacy. In my view, it's a foundational finance book. He's a friend of mine, and we've worked together for a number of years, but I follow his work closely, and he's one of the primary voices I turn to manage my own family's money. Today, we talk about how he became interested in money. He started off early on with a salary of, I think, $18,000 and has gone on to create abundance for himself and now helps many, many others do the same, myself included. He's also a passionate philanthropist, caring deeply about financial literacy and supporting those who don't have it to become more financially literate. He's a boxing ring announcer by night and the lead singer in a band. He lives a rich, rich life. I hope you enjoy this conversation as much as I did. Here's Marc Lichtenfeld. Marc Lichtenfeld, welcome. It is so great to see you, man. I really, really appreciate you coming and sitting down for this conversation.
My pleasure. Thanks for having me, Nate.
Well, there's so much that I'm excited to get into. We've had opportunities to have long conversations so many times in the past, and I always walk away inspired and thinking creatively. And I just, I'd love to get into many of the things that are part of your life. You're best known probably publicly for as an investment analyst, and you're certainly one of the premier voices that I turn to. You're a best-selling author in this space. You have, I know, hundreds of thousands of readers, and also you have passions that you follow. I'd love to talk a bit, maybe later in the conversation about your experience as a ring announcer for boxing matches. You're a lead singer in a band. You have, philanthropic interests through, financial related organizations and even bone marrow donation. It's just, it just blows my mind. But I thought maybe we could start on the financial side because it's what you're best known for publicly, as I said. So before we get there, I did want to ask you one question, which is, of course, this podcast is about a rich life, and I'm always curious, and you and I have had many conversations about this topic. What is one of the most enriching things that's happened to you, or enriching experiences that you've had in the last several months?
And not financial related necessarily, correct?
Yeah, anything that's happened to you, yeah.
So about a month ago, I was playing in my band. I'm the lead singer in a Rolling Stones tribute band. And it was a very, very large crowd, our largest crowd to date. It was a couple thousand people. But right in the front was a mom and her daughter, and the daughter had autism. And the girl was wearing headphones, presumably to keep the noise out because we're a pretty loud rock and roll band. But the mom was holding a drum pad. And the whole show, this girl was drumming along with us. And the mom stood there for the entire show holding this pad, and the girl just, drummed. And it was it was pretty profound. Here I am, dressed up in costumes and playing rock and roll and kind of the whole circus atmosphere of that. And here, we clearly had some kind of effect on this girl, and I hope for the evening at least, the mom and her daughter had a fun night out. So it was really the kind of the contrast between the noise and the crowd, and then this girl just drumming along with us, and again, hopefully having a good time, really landed on me. And that was really what I took away from that particular show. It was really meaningful to me.
That's amazing. That is amazing. It's like, it's interesting how as you live in the world and you pursue the things that interest you, isn't it amazing when these unexpected moments happen that you had never really intended, I'm sure, to have something like that, show up, but when it does, it's amazing.
Yeah, and never expected. You expect sometimes something unusual happen with a crowd, especially in kind of like a festival situation where people are drinking, and you just kind of never know what'll happen, and you kind of need to be prepared for anything. But I don't expect kind of very meaningful moments like that, where you kind of walk away thinking you really did something that might have impacted somebody. When the intent was just to kind of have a good time and have show everybody a good time for a few hours.
Amazing. Well, I would love to, and let's definitely revisit your experience as Mick Jagger and the lead singer of this band. So cool. But let's maybe start with the financial side, which is, again, you are definitely one of the voices I most closely listen to and follow, and you've made a huge impact on me personally, in the way I think about investing. So where did your perspective on investments come from? And, can you talk a little bit about, you've now written a book. Just let's set the frame here. You've written 2 books. But the first of which is called Get Rich with Dividends, which is one of the main investment strategies that you have focused on and that you're known for. Certainly one that's impacted me. What's your background financially, and how did you come into caring so much about investing, and specifically the strategies that you recommend?
Sure. So growing up, I grew up very solidly middle class. My mom stayed at home with the kids, and my dad, when I was really little, was a guidance counselor and then became an assistant principal. So we certainly never went without anything, but we didn't live in the lap of luxury either. We're just real middle class family. And my parents, as far as I know, were not great investors. I do remember my dad saying he pulled out of the market after the '87 crash and then stayed out, which was a big mistake. Yeah. So they were not great investors, as far as I know. But what they were really good at was just kind of the real sensible ways, that those tried and true rules for keeping your financial house in order. They never spent more than they had. They never carried a balance on credit cards. As far as I know, the only debt they ever carried was their mortgage. They always saved. They always imparted that to me. If I got birthday money or when I worked and I, started shoveling driveways, from this, shoveling snow off driveways when I was 10 years old. They always highly recommended that some of that money go into savings. So we were, very much a saving family. And so I really got that kind of sensibility from them. When I got out of school, I was not planning on going into the markets professionally at all. I kind of had no interest. And then I got my first job, and I was making absolutely no money and needed to figure out a way to make some money. So I started looking into the markets and got very, very lucky in that I stumbled across an article that talked about the power of compound interest, and specifically as it relates to investing for the long term. And just the light bulb went on. I just completely understood it and immediately started investing as much as I could, which wasn't very much. I was making $18,000 a year at the time.
Just about to ask, yeah, what was your starting salary? Yeah.
I mean, this was a long time ago.
Sure.
So, 18,000 wasn't as little as it is today, but it wasn't much. And I was living in Manhattan in an apartment with some friends. So, there wasn't a lot of leftover cash at the end of the month, but I did, because of the effect that this article had on me, I did start putting money away into an IRA and figuring out ways to put money aside so that I could invest. And so that really is what kind of set the table for me and got me started on my journey. And then once I got more experience, I certainly learned about the power of investing in dividend paying stocks and then the companies that grow their dividends, which is what my book, Get Rich with Dividends, is all about, which also the third edition is coming out April 4th. So a little shameless plug there. But so my philosophy really became about, not just trying to grow my wealth and help other people grow wealth, but also to increase your buying power. And when I wrote the first edition in 2012, and for 10 years we had really no inflation, so it wasn't a big deal. But I am old enough to remember inflation in the late 70s, early 80s, and I was a kid, so it didn't have much of an impact on me, but I do remember it, and I'm an astute enough student of history to know that it could happen again. So I wanted to make sure that I had a strategy that, should inflation rear its ugly head again, that I'm invested and my readers are invested in a strategy that will keep up with inflation and actually increase their buying power pretty much no matter what. Because especially as you get into retirement, and you're not generating, earned income anymore from a job, that investment income becomes very, very important. And if inflation is eating away at it, that can be a real problem. If it's great to earn a 4% dividend, but if inflation's at 8%, you're losing your buying power every year. So we want to have that 4% dividend growing by 8%, 10% a year if possible.
I see. Yeah. So, and in that sense, it's pacing or outpacing inflation.
Exactly.
What I love about your work, and in particular this approach, which I'd love to dive into more, is that in the conversations you and I have had around money and around the way that you've managed your own wealth, building a machine in the background that is, significantly reduces the level of stress that's typically associated with money for most Americans, probably for most people, is so powerful. I love the way that you have built and recommend a strategy that does just that. I guess maybe at this point in your life, now that you've had so much time to both do this in your own life and teach it, what are your most deeply held financial values and principles at this stage?
That's a great question. Really, it's to kind of continue to feed that machine. As I think that's a really good way that you put it, that it's a machine. I want that machine to be generating income for me no matter what, and for my subscribers no matter what. So, to this day, I continue to contribute as much as I can to my 401k and to my health savings account. And, I guess that I remember what it's like to be broke, and I never, ever want to have that feeling again. So I continue to invest to try to ensure that never happens again. And I would like to think that I'm in a position where that won't happen, but the world can get crazy sometimes, and you kind of never know what will happen, and the market could crash right at the time that you need your money. So having passive income is really my biggest goal financially, for me, for my family, and for my readers too. I mean, everybody wants to have that big pot of money and have lots of zeros at the end of your statement. But for me, what's more important is the amount of income that it will spin off. And obviously, the bigger the number you have in your account, the more income it can generate. But the income is really my principal goal. I don't, if I have enough income to last me the rest of my life, I'm not that worried about, leaving a big chunk of money to my kids. I mean, it'd be nice, but that's not my goal. My goal is to generate enough income for me that I don't have to withdraw funds and worry about the number in the account, the income dropping every single year as a result. So and if I can provide that for my readers where the income is enough to sustain, anything that they need and that they want, then they don't have that kind of stress. And it's really all about relieving stress. I mean, that, like I said, I was broke. I remember what that's like. I remember how stressful that is. Anybody who's ever had any kind of money problems, and that's, pretty much anybody who's watching this, I'm sure, remembers what it's like and how much anxiety it can cause. And it can ripple through, into your personal relationships. It's terrible. It causes divorce. It's a big problem in the world. So anything that I can do to relieve that stress is my goal.
Totally. Yeah. I mean, I think we've all had those moments, and, I kind of feel sometimes like the best, like my money goal is to, if I want to, not really think about it often at ever, if not ever. Right. There's like I personally, I'm an investor and I like it. And so there's like an interest there,
Sure.
but to not have to stress about it, certainly.
Mm-hmm.
Would you say that you mentioned contributing to your HSA and 401k as often as you can? Would you say that if there's a way to build a portfolio that with, enough time, I suppose, is almost guaranteed to reach a point where it creates a significant amount of income relative to the amount put in? Like, is there a way to do it that's, barring something that's like literally never happened and, the whole entire market collapsing or something like that, that it's all but sure to produce a certain kind of return?
I mean, I couldn't use the word guarantee because, as you mentioned, anything could happen. But based on history and historical precedent, if you invest in dividend growth companies, quality companies, and for the most part leave them alone, and when I say for the most part, you should be checking them, let's say once a year, maybe twice if you really want to be paying a lot of attention, but just to make sure that dividend continues to get paid and continues to get raised, that the company does have the cash flow to continue to pay that dividend. But for the most part, if you're leaving these stocks alone over many years, yes, your nest egg is going to grow quite large. The passive income that you generate is going to grow quite large. And historically, we've never seen dividend growth stocks fall over a decade. And even the S&P 500 has only fallen 7 times over rolling 10-year periods since 1927. So meaning, from 1927 to 1936, 28 to 37, et cetera. So even just the S&P 500 has a 92% success rate going back to before the Great Depression. And if you the years that it did not work, the 10-year periods where you actually had a negative return in the S&P 500, the only times it didn't work is if you took out your money at the exact wrong times during the Great Depression and Great Recession, with one exception, which was 1946, but that was also starting during the Great Depression, and but every other time was taking your money out in the Great Depression or in the Great Recession. And even if you took your money out in 2010, so kind of just as just had bottomed after the Great Recession, you still made money. And keep in mind, that's investing near the top of the dot-com boom in January 2001 and taking it out in 2010 after we're not that far from the bottom of the Great Recession. So just historically bad timing, you still made some money there. So, history is on your side as an investor. If you can just leave it alone, if you can not think about it too much. And again, with the dividend growth stocks, the numbers really, really get quite large because dividend stocks and dividend growth stocks in particular outperform the S&P 500 over the long term. So again, you can't guarantee it because anything could happen, or you could need that money at that exact wrong time. But it's over the last century, it has worked and worked extremely well. And we've all heard those stories of the janitor or the secretary that had stock and died, with $5-10 million in their account, and nobody knew it because they bought some shares 40 years ago and left it alone.
Yeah.
It really does work.
Yeah. Yeah. And I mean, it is a little bit counterintuitive because if I have a block of cash and I want it to produce a return, and you're telling me that 90+% of the time it's going to work in my favor, and I would have to have really specific and unfortunate luck for it to not do. That seems like a really good proposition. Is there an age where you think it's sort of, can this be done at any age? Can this be done at any age? And for your readers who are following, building portfolios of these dividend stocks, like, do they start to see the results pretty quickly? How long do you have people writing you saying like, wow, this is working, even if it's not, gotten as far as it might get in the coming years?
Oh, absolutely. So, now keep in mind, anything can happen in 1 year, 2 years, 3 years. So if you're expecting to invest in a portfolio of dividend growth stocks and it's going to change your life within the next year, it's probably not going to, but you will be on the right path to generating significant wealth and passive income. But yeah, I've gotten so many testimonials of people whose portfolios were wrecked in the Great Recession, and then afterwards they found me and a dividend growth strategy, and within a few years they were back on track, and their portfolios were in better shape than they'd ever been, and importantly, they were sleeping at night. We were talking a few minutes ago about alleviating stress. That's the other nice thing about this strategy, is that you don't have to think about it. You don't have to think if the company's going to beat earnings this quarter, and if it's the next Tesla, or if it is Tesla, if people are going to stop buying cars, or the a crazy CEO, or any of these things. For the most part, you set it and mostly forget it. Again, you do want to check on them once in a while, but you're not thinking about your portfolio. You're not watching CNBC, worried about every news event and every macroeconomic event. So it really is about alleviating the stress and knowing that this works, and it has worked over and over again for decades and decades.
Yeah.
And as far as the age, obviously the earlier you can start, the better. And start your kids and grandkids if you can. I started my son investing at 10 years old. But even if you're older, if you're in your 70s or 80s, this strategy is going to be more conservative than most stock investing strategies. It's going to generate income. It's going to grow your income. So even if you're not reinvesting the dividends, if you're collecting the dividends, but if you're invested in dividend growth, then you're hopefully keeping up with and outpacing inflation. So even a year like this year, where we've had some pretty high inflation readings, hopefully next year, because of the dividend growth strategy, your dividends are increasing your buying power, even in a tough inflationary environment.
Right. Yeah, I want to ask you about drip investing. I'll ask you to just briefly explain it in just a second. One thing that I'm thinking of is in reading your newsletter, I know that another part of it is that you're oftentimes will recommend specific stocks that you've previously recommended, but that are still good to, take another look at now, or put a little bit more towards now. So there seems to be another element to the strategy, which is, you build the portfolio, but you can keep adding to different positions, and some of those positions can be more attractive. Is that about right?
Sure. So, there's always, great investment out there. You just have to find it. And sometimes it's something that we've looked at before, and maybe we got stopped out, or something had changed. Sometimes I will no longer recommend a stock because the stock price has climbed so high, so the starting yield isn't high enough anymore. But that could change. Either the stock price comes back to earth, or because the dividend has increased enough that yield is now an attractive enough starting yield. So yeah.
The yield being the dividend price relative to the stock price? So what percent of the stock price?
Exactly. So for example, if a stock traded at $25 and it paid a $1 dividend, that would be a 4% yield. So if that same stock went up to $50 and was still paying $1, that's a 2% yield. That's not very high in the world of dividend investing. Doesn't mean it's necessarily a bad stock, but for what I'm trying to achieve, that's not a high enough yield. But now if that stock's at $50 and the dividend increased to $2, now we're back to a 4% yield, and that might be an attractive candidate once again.
Got it. All right. So one other question about that I just, you kind of reminded me of before, which is you talked about early on, you had very little and you were putting away whatever you could, right? And then just a little bit ago, you said, there could be a situation where, worst case scenario, you would have to take money out that you needed for some kind of situation. How do you think about that? How do you think about, this is how much income I have, let's say, this is how much I would love to push away into this investment account? And how would you invite anyone listening to think about it in their own lives?
So what I do is I put 10% of my salary into my 401k. As long as I can remember, I tried to save 10% of my income. I think when I was making $18,000, I might have been a little. No, actually, I did, because I was saving $2,000 a year, because that was the maximum
impressive. Yeah,
you could put into an IRA at the time. So yeah, since I earned money, I've always tried to put away at least 10%. Oftentimes it's more, but at least 10%, and into my retirement accounts when possible. So I think that's a really good number. I realize that not everybody is in that position to be able to do that, but you should really try pretty hard, because retirement gets expensive, and I'm not talking about golf memberships. It's healthcare. Fidelity just came out with a new estimate for how much healthcare is going to cost seniors out of pocket. The number that I had quoted in my book was, I think, about $250,000, $260,000. That number is now up over $300,000 per couple in their lifetimes, starting at age 65, out of pocket. So retirement's expensive. So, as much as you can put away for as long as you can put it away is really, really important. And, you might have to go without an extra dinner, or, you might have to cut back on a few things here and there, which, look, nobody wants to do. And I'm not the guy who's going to tell you, don't buy that latte. But, whatever choices you have to make to ensure that you're not going to have that stress in retirement, you're not going to have to worry about it, is going to make such a big difference. And I've seen it, firsthand, people who don't worry about their money in retirement. And it doesn't mean that they're, taking cruises, every month, and they're living in the lap of luxury at all. But it means that they don't worry about if they are going to go out to dinner, or, if a pipe breaks in their house and they have to replace something in their kitchen. Those things don't cause them stress, versus I've seen plenty of other people where suddenly something goes in their car and now they're really worried about how they're going to make ends meet that month. And it's really, really sad. And especially if you're in retirement and you don't have a job where you're generating income, and there's no way of generating more income at that point in your life, and expenses start piling up. So again, whatever you can do to push away that stress and that anxiety later in life is going to be invaluable.
Yeah. Your second book is How Not to Drive an Uber in Retirement, right?
You don't have to drive an Uber.
You don't have to drive an Uber in retirement. Yeah. To your point, but you see much more of that. Yeah. You see much more of that these days. And, working just to stay busy and have something interesting to do is a lot different than working because you really need to stressed out.
Absolutely. Yeah. And I mean, I hope I'm one of those people, not necessarily driving an Uber, but I hope I'm doing this job till I'm 80 or higher, because I love it. And you see plenty of people who work because they love it, where they want something to do. But it's not because of the money. And if that's the case, then you can really do whatever you want and not take, any old job just because it pays a certain amount or whatever. That's true freedom to do what you love, and be able to take a job that you love that's meaningful to you, regardless of what it pays.
Yeah, totally. And there's the phrase like, it's not it's not save what you have left over after you spend. It's spend what you have left over after you save. Right.
Yeah.
So I've always appreciated that. And I remember like my first I remember this moment so vividly, when the moment I paid down the last bit of my debt. And I remember it was, I had college debt. I paid that down, and that was a huge relief. And then I still had some credit cards and some other things. And I remember that clear as day, the moment I paid down that last bill, and I just was clean, in terms of debt, was just, it amazed me how lighter I felt, at that moment. So, so really amazing. I would like to mention too, that the newsletter that you write, or one of the new newsletters, is free, right? Isn't it called, it's Wealthy Retirement. And I believe there's, hundreds of thousands of readers that follow it. So just for anyone listening, you have a free e-letter they should know about, and it's easy to find, wealthyretirement.com. And what kind of, just real quickly before we move on, what do you write about in Wealthy Retirement?
So there's a lot of different personal finance topics. We certainly talk a lot about the stock market. We talk a little bit about fixed income. On Wednesdays, I have a column that's been popular for years called Safety Net, where I analyze the dividend safety of a particular stock that's recommended by readers. So there's just a wide variety of financial content, and it's really written for people who are not necessarily experts. One of the things I've tried in all my books and my newsletters and everything is to make this information very accessible, and for people who've never done it before, because we do have a lot of readers who are new investors or who haven't even started investing yet and are broaching the topic for the first time. So I want to do everything I can to help them feel comfortable that this stuff really isn't as complicated as a lot of people fear. You can make it complicated if you want to, and the institutions certainly do. If you've ever read an analyst report, it gets really, really complex, but it doesn't have to be at all. And especially some of the kind of the basic personal finance topics, for sure. But even analyzing a stock, and Safety Net is kind of a perfect example. I just go, very clearly, here's why this company can or cannot afford its dividend. And you'll very quickly, in just a couple of minutes, understand why that would be the case.
Yeah, definitely. Thank you for that. And it's always amazed me how important the sense of empowerment is. Like when you go from not understanding something, like, there's plenty of people out there who have incredible talents, but stocks might not be one of them. And so this area feels murky and uncertain. Sure. And then once you just get a little bit of understanding, which, as you say, doesn't have to be that hard, it makes it's unbelievable how different you feel, how much more empowered you feel.
And like many things in life, anything that you're unsure of or that you haven't tried yet or that seem daunting, those fears are usually bigger than reality. Once you start getting into it a little bit, you think, oh, that wasn't quite so bad, or wasn't as stressful or as complicated as I thought. And the great thing about especially the markets is there are so many resources for people who want a little bit of help or advice, whether it's a financial advisor who's going to take care of everything for you, to people like us that provide information for you for free or based on a subscription or what have you. But there's just so much information out there at every kind of level that you really don't have to be intimidated, because once you get your feet wet, you're going to realize the water's not that deep and it's not that cold, and actually feels kind of nice.
Right. Sure does. All right. So let's, if we could, I'd love to talk about your first book, because it's the book that you're that I know you for best. And I think most people do. Get Rich with Dividends. As you mentioned, you're just publishing a third edition of that book, which was a #1 bestseller. And I thought it was really cool that it won the Book of the Year award from the Institute of Financial Literacy, which, that says a lot. So what why were you compelled to write a third edition? Let's start there.
Well, as I had mentioned earlier, when I wrote the first edition in 2012, and then for the next 10 years, there had been no inflation. Even though the book was designed to beat inflation, there hadn't been any. So I thought it was important to address the fact that, okay, now we are in an inflationary period, and this is why the strategy is so important. And also to update, a lot has happened in the market. Think about from 2012 to today. We had a raging bull market. We had the COVID crash. So there's been a lot of things, a lot of volatility in the market. And I thought it was important to look back at the strategy, see how it's done, incorporate all that data, from the last decade into all the other decades, and kind of show, was the last 10 years an anomaly? How does it fit in, with history? It's really needed to kind of complete the work, so to speak. And then lastly, there's I included a chapter on crypto because there are some cryptos that pay dividends, and I get a lot of questions about that. So I did want to address that because in 2012, while crypto existed, I don't know if any cryptos paid dividends at that time, and if they did, really nobody was talking about it. It certainly wasn't in the mainstream at that point. So I did think it was important to address it.
Nice. Yeah. Bitcoin at that point was like pennies. I think it was very early stages.
Only the real believers, those early believers, were investing in Bitcoin at that point.
Right. Yeah. Okay. So, all right. So you mentioned before, but the book is about companies that pay really strong dividends. And I guess I know there's a term you use, perpetual dividend raiser or dividend aristocrat. Can you talk about what that is and why you feel so strongly that it's important to focus on companies like that?
Sure. So dividend aristocrats, and that's not my term. It's an S&P Standard & Poor's term. A dividend aristocrat is a member of the S&P 500 that has raised its dividend every year for 25 years or more. And there are plenty of companies out there that have raised their dividends for less than 25 years, let's say 5 years, 10 years or more, and also that are not members of the S&P 500, including lots of small caps. People would be surprised that there are small cap dividend payers or small caps that have raised their dividends every year, but they exist. So I wanted to encompass all of these stocks because they all, this whole subsector of dividend raisers that are not aristocrats, I believe, have an important place in a portfolio. And so that's the term I came up with, these perpetual dividend raisers. And the book basically, so I don't, just to be clear, I don't focus on specific companies. So in the book, I'm not saying, hey, buy Johnson & Johnson, buy this company, but I do give lots and lots of examples. And the reason it's so important is, we talked a little bit before about the income and keeping up with inflation, and that's critical and kind of the key component of the strategy. But the reason that it works is because if a company is raising its dividend every single year for decades, there are a couple of things going on. One, the company is generating lots of cash flow, and they're likely increasing their cash flow every year. And that's a very, very healthy sign for a company. And most people focus on earnings, and earnings are very important, but cash flow is really the lifeblood of a company. It's literally the cash that's coming in to the company versus the cash that's going out. Whereas earnings have non-cash items. There are things like depreciation and amortization and stock-based compensation and other things that make up the earnings number. But cash flow is really just the cash coming in minus the cash going out. So if a company is raising their dividend every year, they're generally growing their cash flow every single year. And that's very positive, obviously. And it also gives you a bit of a buffer. A company that's growing their cash flow every year, then their stock price should be following as well. You're probably not going to have a cash flow that's going up and a stock that's going down over the long term. In a bear market, certainly things can happen and a stock can decline, but these tend to be more conservative stocks as a result of this growing cash flow. that's really kind of a critical aspect. And the other thing is, I mentioned that they're conservative, so you're not going to have these wild fluctuations. Typically, again, anything can happen. You could be, if you're in Johnson & Johnson, they could have a drug that had been approved that suddenly has a terrible side effect, and short term, anything can happen. And I don't really think about these kinds of stocks in the short term. But over the long term, these stocks work. They outperform the market. They tend to be less volatile in bear markets. So it's a way that you can invest for the future in companies that are growing and are going to let you sleep at night. And the last thing I do want to mention about these companies is that when a company has raised their dividend every single year for 10 years, 15 years, 20 years, and then there are companies that have done it for longer than that, 50 years, 60 years, investors have come to expect that, right? They've raised that bar. They've told investors that this is who we are, this is what we do. Mm-hmm. So you can imagine what would happen if a company suddenly doesn't raise the dividend after 20, 25, 30 years of doing it annually. The CEO probably has to update his resume. They've set the bar very high. And so they're going to do what it takes to maintain that and make sure that they can continue to raise the dividend. And if they don't, then that's a pretty clear message that something has changed. So I'm not even talking about eliminating the dividend or cutting the dividend. I'm just saying company raises their dividend for 25 years in a row, and then suddenly this year they leave the dividend the same. That sends a strong message that something has changed. And you as an investor, you want to look pretty closely at the company and what that message is. So it's a show of confidence by management that they raise their dividend every year, and especially if they talk about that they want to grow the dividend to continue, and many of the CEOs do in their press releases and their conference calls, they do mention that they plan to grow the dividend for the considerable future, or even by a certain percentage. So they kind of signal Wall Street and investors what to expect. And it's an important message, and they set that bar high, and it's a big vote of confidence.
Yeah, definitely. And so it sounds like cash flow, their expression of confidence, and also the expectations of the market are all there's a lot of incentives that, well, particularly the market part, but incentives to continue to do so. How many, like if someone's listening to this and they don't have any dividend stocks in their portfolio, maybe don't even have stocks, how many dividend stocks do you think is a good number to have, like a kind of a starter portfolio?
I would want to see someone generally have, if you're just starting out, let's say 5 to 7, growing it to 10, and then maybe more. And the reason is I want to see different kinds of stocks in there. So, I want to see different sectors, whether it's healthcare, industrials, real estate, energy, but I also want to see different size companies. I want to see big caps, mid caps, small caps. I want to see different geographies. Not everything necessarily has to be a U.S. company. Some can be, global companies. Some can be strictly foreign companies. A Brazilian miner, for example. So you want to have that kind of diversity so that something is always working. If there's a bear market, let's say, and everything is kind of going down, maybe you have a mining stock that is doing well, or maybe you have something in a different part of the world that's doing well if American stocks are underperforming. Small caps may beat large caps at one point, or vice versa. So, I do want to see someone eventually get up to, let's say, 10 stocks or more. But to start with, if you can start with 5 solid companies, let's say, 1 or 2 small caps, 1 or 2 large caps on a mid cap company, I think that's a good place to start. And then as you continue to save and invest, you can add more.
Okay.
And one thing I should add is as now that stock trading is pretty much free with most brokers, it's not it doesn't cost you anything to do that. So even if you can only afford 1 or 2 shares of a stock, that's not a problem. When I first got started, it cost $49 to place a trade. And the first trade I ever made, I had $300 to invest. So, That ate up a big chunk of my capital. But today, there's a $20 stock and you can afford 2 shares, go for it. It doesn't cost you anything. And you can always add more at a later date, and it won't cost you anything else other than your investment capital.
Yeah, no, I appreciate you saying that, because it's really not that complicated to get started, and it's better. Would you agree? It's better to get started small than to wait until you have some certain amount and then get started, right?
Yeah, and I think that's kind of a misperception that people think, well, I can't, I shouldn't get started till I have $1,000 or $5,000, whatever that number is. If you have $100, if you have $50, again, it doesn't cost you anything with the online brokers. Buy 1 or 2 shares of stock, get your feet wet, see how it feels without having a whole lot at risk, and you can always add more, again, without it costing you a penny in fees or anything. So you can really go at your own speed and get started as early as possible.
Nice. All right. So one other thing I wanted to touch on here is that dividend stocks are actually, it can be good to hold them through periods of contraction if you are reinvesting those dividends. Can you just briefly describe why that is and how that works? Sure.
And in the book, I talk about a bear market can be a dividend investor's best friend. So if you're reinvesting the dividend, so when you own a dividend stock, there are 2 things that can happen. You can get paid the dividend, where the amount gets deposited right into your account. So let's say you have 100 shares of a stock that pays $1 a share dividend. You get $100. That $100 goes right into your brokerage account, and that's cash you can do whatever you want with. Or you can automatically reinvest it. You tell your broker that when that dividend comes in, I want it to automatically buy more shares of that company. And again, it's free to do it with, I think, almost all brokers. So it doesn't cost you anything. And so if you own 100 shares of a $25 stock that pays out a $1 dividend, you would now get $100 that would automatically buy you 4 more shares. And so now the next time that pays a dividend, now you have 104 shares. So you're going to get paid $104. And so you reinvest that into the next, into the stock again. And the next time you'll get 108 point something, $109. And that's the magic of compounding. And the numbers really, the escalation of your wealth when you reinvest dividends is amazing, especially once you start getting out in years. To be honest, the first few years, it's not going to move the needle that much, right? If you're getting a 4% dividend, you'll have 4% more shares after 1 year. But after you get to 8 years, 9 years, 10 years, and if you can leave it in for 20 years, 30 years, I mean, the numbers can really get insane. After 10 years, one-time investment, you can easily triple your money. After 20 years, you can 10x your money. So that's another reason why I say, get your kids and grandkids doing this, even if you don't have 30, 40 years to do it, because the numbers will get nuts for them, for sure. So going back to your question now that we kind of established what reinvesting the dividends is. So if you are in a bear market, so you have that $25 stock and you were getting that $1 per share dividend. Well, now we hit a bear market. And now that $25 stock is only worth $20. But the company, nothing has changed for the company fundamentally. All that's happened is we've hit a bear market. So the company's still growing its cash flow. The company's still paying the dividend. And so now you're getting paid a $1 dividend on a $20 stock instead of $25. So when you reinvest that dividend, now you're buying 5 shares instead of 4 shares. So the next dividend, you're going to get paid $105 instead of $104, and you're reinvesting those dividends. And so in a bear market, you start the compounding machine really accelerates because you're getting to buy many more shares than you would have if the stock hadn't fallen. So as someone who is reinvesting their dividends, when the bear market hits, I certainly feel for my readers. Nobody wants to see that. But as someone who is reinvesting the dividends, for anyone who is, a bear market is a great thing because they don't last forever. They historically last, I want to say 9 months, might be a little bit longer. Don't quote me on that, even though we're recording this here. But they generally don't last very long.
Right.
And within 2 years, they're mostly over. And you typically also have made your money back within just a couple of years. So when markets tank, again, as long as nothing has changed for the company and they're paying their dividend, you get to buy more shares at a cheaper price, which generates more dividends, which buys more shares, which generates more dividends, and it really accelerates compounding. So, you don't want to have a bear market when you're ready to take the money out if you need to sell the stock, but if you're reinvesting the dividends, it is fantastic, absolutely fantastic. So if you are reinvesting dividends, don't sweat the bear market at all. It's going to do wonders for your portfolio, and you're going to look back in 5 years and look at the amount of shares that you were able to buy then compared to, let's say, now, and you're going to be really happy that it happened.
Yeah, definitely. It pours fuel on that whole machine and really accelerates things. Yeah, my father actually he started to retire in the last couple of years of all times, but he's done a lot of he's done a lot of this. I think he follows your work amongst others, and so he's put himself in a really good position to benefit also. But as you say, the market definitely spends more time in an uptrend than it does a downtrend. So all things being equal, these can be blessings.
Yeah, I mean, we know markets go up over the long term. That that hasn't changed in as long as the stock market has been around, that has not changed. We certainly have periods of volatility, but that hasn't changed.
Yeah. Yeah, and the speed of innovation, the speed of technology, I mean, human ingenuity is just a marvel. And so yeah, so it's exciting to watch, and I share your optimism. One of the things that I know you talk about is something called the 10, 11, 12 system. Could you just briefly describe what that is and how this has changed your own perspective on dividend investing, on investing?
Sure. So the 10, 11, 12 system, which I write about in my book and is the basis for the strategy in my newsletter, also the Oxford Income Letter, it's basically just putting kind of a framework and some goals around buying dividend growth stock, so that you have kind of a starting point of where to look for dividend growth stock. So you might find a company and say, well, this seems like an attractive company. It has a 2% yield. Is that going to get me to where I want to go? And so the goals of the 10, 11, 12 system is, if you're collecting the income, if you're collecting the dividends, you're not reinvesting, is to achieve 11% yields within 10 years. And if you are reinvesting the dividends, it's to generate 12% average annual total return over a 10-year period. And 12% annual returns will triple your money in 10 years and 10x your money in 20. It'll more than 10x. So, and that basically, those numbers for the most part should beat inflation. I mean, I know we had a 9.6% reading earlier in 2022. Certainly we could hit double-digit inflation at some point again in the future, but for the most part, considering that the average inflation rate in the United States over the last century has been about 3.4%. Even if we go higher than that, even if we double that, if you're generating 11% yield and 12% average annual total returns, even after taxes, you're beating inflation. So I wanted to come up with goals that would, again, increase your buying power, regardless of what happens over the long term with inflation. And so to do that, it's a combination of finding companies with the right starting yield and the right dividend growth. And so the higher the starting yield, the less annual dividend growth you need. And the lower the starting yield, the higher the average annual dividend growth you need. And so in the book, I talk about kind of different ways to look at that and how to figure that out. And so in the stocks I do recommend to my readers, for the most part, are companies that will match those goals. And if they don't, then they're not included in my instant income portfolio, which is the one that's the goal is to generate 11% yields, or the compound income portfolio, which is reinvesting the dividends and trying to go for 12% average annual total return. So if a stock, I could love the stock, I could think it's the next Facebook, But if the dividend yield, starting yield, and the anticipated dividend growth won't hit those goals, then they won't go in those portfolios. So that's really important.
This is why I love this. I mean, I love the strategy, and I love your book because it's, it's so interesting to observe, like people in my life that I've talked to during this period of inflation, the inclination, like you don't really have an alternative. Either inflation chews away at your savings if you don't have it invested somewhere, or you have it invested somewhere. And if you have a strategy that almost always is outpacing inflation, or at least keeping up with it, and to your point, it's so much lower risk than so many of the other investment strategies one might try. And you've got a situation where you're actually, a happy camper when the market's correct, and when you're able to buy more shares and the compounding kicks in even more. I mean, that really is quite a comprehensive set of benefits from an investment strategy. Yet, our inclination is oftentimes not to do the thing that might be best for us. So I can't recommend the book enough, certainly. And your strategy is something I've definitely used myself and continue to use. And it's really amazing.
Good, thanks. I'm glad to hear that.
Yeah, of course. Yeah. All right. One other kind of financial question that I was thinking of, are there ways that is there like a go-to way that you like to augment a dividend portfolio strategy to create additional returns or additional income?
Sure. So I got my start on Wall Street on a trading desk, a high octane trading desk where traders were shouting orders at me, and that was kind of my the beginning of my career, and I was already investing on my own as an investor for a number of years, but my professional career really started, with trading. So that's still in my blood. So I do still like that. So for investors that do have their long-term money set aside and it's invested properly, I do think that there is a place for trading. I kind of look at it as a barbell approach, where on one side you have the long-term money that's taken care of, and I wouldn't recommend actively trading until that money is put aside and invested for the long term. But once it is, trading, and as you know, a lot of our readers, trading is fun. They enjoy trading. They enjoy following the markets, and so I still like to trade. I like to recommend trades, and it can be a great way to add a little bit of extra capital to your accounts, generate some extra income, generate some play money. You have to be comfortable with risk, because when you're actively trading, anything can happen in the markets. But it's a really fun way to stay in tune with the market, to be an active participant, to learn about interesting companies and interesting concepts as far as trading and investing. So that's still very much in my blood, and I still love to trade.
Okay. So foundational is everything we've talked about up to this point.
Yeah.
Once that's established, well, first of all, I think once that's established, one of the things that I really love about, and you touched on this earlier, but when I think about living a rich life, it has to do with so many things, including my finances, but so much more. As you mentioned before, divorce rates and relationships and experiences and your health and all these other things that honestly can fall by the wayside if you have stress around money. And so even the wealthiest people I know, many of them, and I've talked to them candidly about this, still experience stress around money. It's just ingrained in us. So by reducing I think building that foundational portfolio has that natural effect, because you feel like you have some steady, stable control, but then you can put some money to work in trading. So that's all very, very helpful. Thank you so much. All right. I want to talk about a couple other things before we close this, if it's okay, because you have such an interesting approach to life. And we touched on this in the very beginning, but amongst other things, I know you and have had the privilege of coming to see you once before, as a ring announcer in boxing matches. And some of the people that read your newsletter might not know that. And so when did you get into that? Like, how did you decide to pursue that passion? And I'll just give you a kind of a quick shameless plug here. I know that you recently were inducted into the Hall of Fame of ring announcers in some capacity. And so it's amazing. But can you just talk a little bit about your experience there? What that adds to your life?
Yeah. So getting inducted to the Florida Boxing Hall of Fame is, I wouldn't even say it's a dream come true, because it's when reality exceeds your wildest dreams. But yeah, as a kid, I was just always in love with boxing since I was about 12 years old, and always dreamed of being a part of it. And I was working as a freelance writer, covering fights, just basically so I could get ringside seats for free. And there was a local promoter here in Florida who had a ring announcer who was, to be honest, quite terrible. So I went up to the promoter and said, "Hey, if you ever need a ring announcer, let me know." And I've, as I mentioned, I was in a band. I'm in a band, and I've done theater, so I'm used to performing on stage. So having been a diehard boxing fan for decades, and having watched, I don't know how many hundreds, if not thousands, of fights, I kind of know, or I knew at the time, what a ring announcer does and how to do it. And so I just said to the promoter, "If you ever need somebody, let me know." And much to my surprise, a few months later, he called me and said, "I've got a show on ESPN. You want to be my ring announcer?" So of course I said yes. And from there, I just really hustled every time any show was announced anywhere in the country. I called up the promoter, and if they wouldn't use me for TV, then I said I'll do the undercard. Which if you watch boxing on TV, there's usually fights before the TV fights come on. It's called the undercard. It's kind of like, if you go see a band and there's a warm-up band. And the really big ring announcers typically don't do the off TV fights. So I did all those off TV fights, and just, I got lucky. I was in the right place at the right time and started doing big TV fights right away. And yeah, it's so much fun. And every time I'm in the ring, I'm reminded of that, 12, 13-year-old kid and watching in my basement at my parents' house, of dreaming of being a part of this somehow. And I get the best seats in the house. I'm sitting in front of the guy that paid $1,000 and get to be a part of the action. And it's so much fun. There's almost nowhere I'd rather be, other than being with my wife and kids. There's nowhere I'd rather be than in the middle of the ring.
So what would you say the takeaway is for that? Like, it's just so cool that you have this experience now where you get to pursue something that was like such a passion and interest for you in this way. Like, do people ever ask you, like, questions like the one I just asked you, how did you get started? But also, how can people create or cultivate or lean more into their own passions? Like, do you have any perspective or thoughts that you could share on that?
Yeah. I've been thinking about this a lot. And as it pertains to, playing in a band also, one thing that as an adult, I really tried to focus on was doing things that made me happy. Because when I was younger, in high school, like a lot of kids, I really wanted to fit in, wanted to be cool. And I definitely stifled myself as far as pursuing certain things in order to not stand out and be cool. For example, I was really, even though I was into rock and roll and playing in bands, I was also into musical theater. And that's, that just wasn't a super cool thing, at least in my high school at the time. So I didn't pursue those things. And as I got a little bit older, and fortunately, I kind of learned this early in my early 20s, so it didn't take too long. I kind of realized that if I had just let my freak flag fly, so to speak, I might have been more interesting to more people than just trying to, stay in this box that I thought was, what you have to do to fit in. And so, at like I said, my early 20s, I just said, well, I'm just going to pursue what makes me happy at this point. And And so that's when I started pursuing acting actually in New York, and did some musical theater there. And that's just kind of been my philosophy, as long as it makes me happy and doesn't hurt anybody, which, my hobbies certainly don't. As long as it doesn't hurt anybody, and it makes me happy, then go for it. And it doesn't mean that I'm not, I never have been intimidated in asking for certain opportunities, but what's that expression? You miss 100% of the shots you don't take. And I just kind of felt like I have one life to live as far as I know, and I want to be an example to my kids of how to live a full life, a courageous life, and not have regrets. It doesn't mean I have no regrets, but everybody does. But I don't want to have missed opportunities because I was too afraid or too intimidated to ask for them. So that's really been kind of how this all happened. And then once I did get in, and that door opened a little bit, I was pretty relentless about going after it, because it was something I really loved, and kind of saw that there was an avenue to becoming, fairly successful as a ring announcer. So I went after it pretty hard.
Mm-hmm. So I really appreciate that. I really appreciate that. And I totally agree with you. And I feel, maybe it's just because of my current age, but I feel like sometimes if you're not fully aligned with your creativity in your career, then sometimes in the middle of life, and there's some stage where you kind of, the creativity might fall away a little bit, and you're pursuing, just kind of a career, or you're raising family, or what have you, right? But you have managed to keep all this up for all this time, which is so impressive. And so what would you say to someone who might currently feel that there's like a creativity inside of them, and whatever they're doing, they're not feeling like they're fully expressing that? Like, I'm sure you've given your kids words of wisdom, or your friends or other people, but what would you say?
Sure. So, if that's from a job perspective, and if finding another job is not an option, I mean, hopefully, right now we're in a pretty hot job market. So hopefully, there are ways you can find a job that will more, satisfy and scratch that itch. But if that's just not possible, there are so many ways of being a creative person these days, and just pursuing the things that you're passionate about. And like I was saying, there's we only have one life as far as we know. So to not pursue happiness, to me, is really a big waste. And that doesn't mean that you can't have stress and have difficult times and all that, but to me, the goal of life should be to enjoy it. Otherwise, what's the purpose of all the hard work and all the sacrifice and enduring the difficulties that we have? So, that's really what it's about for me. And so, however you need to kind of scratch that creative itch, go for it. And there's so many resources out there to help you find that. If you're an artist but you don't know how, kind of how to do that, or if you're a writer, whether it's online or in your community or wherever, you'd be shocked if you just kind of put things out into the universe, what you'll find, and talk to people and let them know what you're interested in, because you never know who's going to say, oh, actually, I know someone who you should talk to. And what I have found in my life is, very often when I do that and just kind of tell people, hey, this is what I want in life, people start connecting you with other people who might be able to help you, or have similar interest, or you might be able to help them, or what have you. And things start to happen. It might not be overnight, but it really does. So I'm a very, very big proponent of, if you have an idea, or even if you don't have a clear idea, but a general idea, put it out in the universe and see what happens, because more often than not, things start to make their way back to you. Mm-hmm. Mm-hmm. And I know that sounds a little kind of mystical, whatever, but I've seen it work over and over and over again, where, if you just talk to people, and very often things do come back to you.
Definitely. Absolutely. Yeah. I completely believe that. And I've had that happen in my life many times. And, yeah, so it's very well said. I also think that it like for someone who's working a 9 to 5 or has, maybe working 60 hours a week or whatever, is very busy, has raising a family, feels like how could I possibly find the time? I don't know if this is true. I'd love to hear you confirm it, but it seems to me like making space for these other passions
Mhm.
actually has the kind of the opposite effect, which is it's becomes fuel. It becomes energy that
Right.
you can then pour into the other parts of your life. Has that been your experience?
For sure. And there's an expression: if you need something done, ask a busy person, because they know how to allocate their time. They know how to get things done. And yes, it absolutely, when I come back from a gig or from a fight, I'm very charged up and fired up and ready to get back into the markets and writing. And I'm a better writer because I have these other outlets, for sure. And the other thing too is, I want to be very clear. When my kids were little, I wasn't doing all these things. I mean, I was doing the boxing when they were little, but I did not have time for a band. So I couldn't do a million things at once. So you do have to kind of pick your spots. And I did give certain things up when I was doing too much, but you can navigate that, and you can pick that one thing that'll make you happy for now, and then maybe that goes, and you can expand that, or you can do other things as your time frees up, what have you. But I think it is so important for your work, for your mental health, for your relationships, to have those things, because if you're happy in other parts of your life that may or may not have anything to do with, let's say, your partner, you're going to be a happier person at home, and that's just going to make life better for everybody. I know I come back from a fight, and I'm super happy, I'm charged up, and I'm sure I'm a better husband and better father, because I'm in a happy place than if I was just miserable or wishing I was doing something else, or what have you. So I think those things are so important. There's obviously a line between being selfish and being a good husband, father, partner, friend, what have you. But there's plenty of space, I think, for most people to pursue things that are important to them, even if it's just a little time away to scratch that itch. Will make you such a better person in all areas of your life. You'll just be so much more fulfilled.
I love it, man. I love it. I completely agree. All right. Maybe one last thing I wanted to touch on, one last question before we go is, you, among so many other things, I know, have poured yourself into some philanthropy as well. And many people don't know this about you, but you're a bone marrow donor. You're also working closely with the World of Money, which is a really amazing organization. Can you just say a couple words about that, the role that those parts of your life play in your overall, sense of who you are, and what importance do those pieces play for you, and how do they contribute to your life in addition to the causes?
Sure. So being a bone marrow donor in 2015 through an organization called Gift of Life, that was a one-time thing. It was unbelievably profound. At the time, it was a 3-year-old girl with an immune disorder that they said would have killed her if she didn't get a transplant. So when I got the call, I really felt like I had no choice. Obviously,
You had signed up to receive the call,
I,
right?
Yeah, I had gotten swab. Basically, all it is a mouth swab, and then you're entered into a bank, and then if you're a match, then you go through some testing and what have you. So that was a one-time thing, and it was one of the most profound things I've ever done. And but like I said, it was just a one-time thing. But World of Money is a financial literacy organization, and financial literacy is something that's really, really important to me. We've spent a lot of time today talking about how much stress finances can cause people. And, if you're not financially literate at all, obviously that can cause a tremendous amount of stress. But there's a tremendous amount of inequality in the world. And some of it has to do with financial literacy. Financial literacy is not taught in most schools, and especially in certain areas. So World of Money works with kids that are mostly from urban areas. And for me, it's the way that I can best use my skills and abilities to help level the playing field a little bit, in that we're teaching kids to be self-sufficient at an early age. And that, these kids, so the group that I work with are 12 to 17, and there's even a group that's younger. But they learn about the market. They learn about commodities, about bonds, about compound interest, about debt, bank accounts, crypto. By the end of their program, I mean, they really know how money works, how to grow it, how to save it, how to invest it. It's an amazing, amazing program. And I just find it to be so important to, like I said, it's a way that I can help society be a better place, because the fewer people that are in debt, the more people that are prepared for retirement or prepared to buy their first home, and then can teach their kids, the better the world's going to be. I mean, so many of our problems, both on an individual basis and on a government basis, are because of astronomical debt. So working with kids to set them up for success in life, regardless of whether they become an investment banker or a bus driver or anything, if they can be set up for success, as I said, my dad was middle class, but he luckily had the tools to save, not get into debt, and just look at the ripple effect that it's had, not just from him, but then from me and now my kids. So if we can kind of interrupt some of the dysfunctional financial habits and create some better ones, it can just have a really important effect. And so I love this organization, World of Money. I teach in their summer program, and I'm on their advisory council, and it's a great organization. If anybody wants to learn more about it, it's worldofmoney.org.
Nice. Worldofmoney.org. I was just thinking the generational impact that can have, which is really amazing. Marc, this has been so much fun. I really have enjoyed this conversation, and I look forward to seeing you soon. We're going to see each other in a couple of weeks. Hopefully we can go on a run and keep you in fit shape for your lead singer role. But is there any kind of parting words, or maybe what's the best place that people could look you up if they want to learn more?
Sure. So as we mentioned, wealthyretirement.com is our free website. So you can sign up for free, and we'll send you our information on stocks and bonds and personal finance, all kinds of personal finance issues. So definitely check out wealthyretirement.com. I'm also on Twitter at stocks, the letter N, boxing. So I mostly talk about stocks, but occasionally I'll throw in a boxing comment here or there.
Stocks and boxing. All right. Sounds great. Thank you so much. And it's been real. It's been real fun.
This has been great. Thank you so much.
Thanks for checking out this video. Make sure you hit subscribe. I'm Nathan Hurd, also known as the Rich Life Guy. You can follow me at the Rich Life Guy. Also check out Rich Life Lab, which is the podcast available everywhere. And leave a comment and let me know if this video landed for you or what else you'd like to hear from me in the future. Thank you so much.